Let's talk for a minute about understanding indexed annuity and indexed universal life insurance returns, because one of the more frequent questions I get asked is, well, how is it possible that you can make 7, 8, 9, 10%? There's annuities, as I'm recording this, there's annuities with a 10-year look back of 11.82% with no fees and no losses. There's easily multiple cash value life insurance policies that when it's set up properly, they've been making 7 to 9% tax free for the last 10, 20, 30 years. Both annuities and the life insurance products set up properly. When you use the best of the best, they beat the market. When you use crappy ones, they don't, of course, but the best of the best beat the stock market in every time frame that we can measure. But how is it possible for an insurance company-based product, to be paying you more than they are earning on the money you give them? Great question. You should have a huge epiphany. Most people do when they learn this. Let's jump into it. How can they pay you 7 to 12% when they only earn 4 to 6? I won't do it on this recording, but I could pull up any insurance company's vital signs reports and show you that Allianz made 4.69 on their general fund over the last 5 years. Another company might have made 5.5. Another company might have made 6. How are they paying 7 to 12%? Well, let's first look at the basic arbitrage model, what insurance companies do every single day trying to get into debt. This is why I don't pay off my mortgages. I don't make large down payments. I don't use 15-year fixed mortgages. I don't make extra principal payments. I understand borrowing at 2 or 3 and earning 5 or 6 is a masterful strategy. All banks, all insurance companies exist to get into debt. What's the basic model of an insurance company? You invest $100,000. Doesn't matter if you do it up front, buying whole life, buying universal life, buying an indexed annuity, buying a fixed annuity, a MIGA. You put it in over time for whatever, for insurance or something like that. If you give them $100,000, they put it in their general fund and they make 5 to 6% on your money, other people's money. So they're generating $5,000 to $6,000 of profit or revenue on someone else's money for every $100,000 that they have been able to get from consumers. Now, they keep 2%, about $2,000. They keep it for profits, commissions, and overhead. Profits, commissions, and overhead. They keep that money. They put it in their pocket. They make $6,000, let's say, on your money. They keep 2, which is why they want to go into debt. They want more debt, more debt, more debt, more debt. They actually pay commissions for people to help them get into debt, which is why I don't listen to David Ramsey or Susie Orman. Because borrowing at 2 or 3% and earning 5 or 6 is the most intelligent thing you could ever possibly do. Nobody should be trying to get out of debt with debt as cheap as it is. That's a major financial mistake. These insurance companies and banks know that. They're trying to get into debt and pay low interest to earn high interest. They earn $6,000. They keep 2. What does that leave for you? You are credited 3% to 4%. So you get $3,000 to $4,000 for every $100,000 that's in there. If I showed you the 20-year look back on whole life and what the dividends actually are that they pay, you'll see that they're 3.5% to 4%. If we look at index crediting, any type of guaranteed interest, so an annually declared universal life insurance policy probably pays 4% right now. Guaranteed interest on long-term 5-year, 7-year, 8-year, 9-year, 10-year fixed annuities, which are like CDs. They're going to be in this range, 3% to 4%. Really what we're seeing in the world of insurance products is they make 5 to 6, they keep 2, you get 3 to 4. That's why for decades, insurance products were a conservative tool that people only used in their 70s and 80s. Today, the insurance companies have come up with much more modern strategies. We don't have to use the horse and buggy anymore. We now have cars. So the genius of indexed products, which we've now had for 20 or 30 years, they've taken over the world of finance. Anyone paying attention is going to move money out of the stock market into an index scenario unless someone lies to them. Someone at Edward Jones, Merrill Lynch, Morgan Stanley, Fisher Investments, AG Edwards, Fidelity, UBS, someone lies to them and says the market actually makes 8 to 12% in the long run, which it doesn't. Very easy to prove that. And they tell them, oh, you're going to have limited upside potential in the index products. When the market goes up, you're only going to make the first 4 or 5%. Well, yes, in a terrible product designed poorly from someone who does not know what they're doing, Of course, you could say bad cars don't drive very fast. I agree with you. That does not mean there aren't Lamborghinis. It doesn't mean there aren't race cars. There aren't cop cars. The genius of properly designed index products, you and your advisor decide, I want you to risk my small portion of interest every year. Please risk my 3% to 4% each year. What does that mean? If you put $100,000 in over time or upfront and it earns $6,000, the company keeps $2,000, and you have $4,000 left in whole life fixed annuities or a annually declared universal life insurance policy, you might have your account grow from $100,000 to $104,000. So you have conservative growth. In an index product, you and your advisor are saying, gamble that every year. Take that to Las Vegas, not my 100 grand. Don't ever risk all the sheep that I have that are having babies. Don't risk the farm. But the new babies for 1 year, totally risk it. You go ahead and risk my $3,000 to $4,000. So I either lose it all or I make a ton of money. What do they do with that? They buy options. Options are an all or nothing strategy, the way that they do it. The market goes down, you lose everything. So you put $100,000 in. First year, market goes down because they bought options for you. You lost all your interest. You have exactly $100,000 if there's no fees, because we gambled the interest. That was the decision between the advisor and the client. And the market went down. Well, is that bad news? No, it's the same as being a clairvoyant and saying, I think the market's going to go down, and moving everything into cash and not losing a penny, but preserving your account. And you didn't lose any money when the market went down. It's genius. Zero is our hero. You can't lose with this strategy. If the market goes up, though, and you bought options, they make a killing on those options, and you get to keep some of that money, whether it's based on a cap, a participation rate, or a spread/margin strategy, which I've taught elsewhere. Let's say it's a participation rate to make it easy. You're getting 70% of the ups. The market goes up 20%. You get 14. Someone else gets the other piece, but you have no losses. So they make 4 to 6% in their general fund, but because we're using options, risking and gambling the little bit of interest you would have made each year, you can actually make more in your indexed annuity or indexed universal life insurance policy than the insurance company is making through the use of your money. It's very simple. Don't gamble with your principal, but gamble every year or every 2 years with the little bit of interest that principal would have given you over the short term. That's how you do it. We are betting on volatility rather than a market direction. What do I mean by that? You can try to short the market and say, I hope it goes down. Or you can try to buy the market and say, I hope it goes up. Well, in indexed annuities and indexed universal life and any of these index crediting strategies, we're saying, I'm just going to bet that it's going to go somewhere up or down. And as it goes, it's going to spaz out and go up and down, up and down, up and down, up and down. Volatility makes you money. If when the market goes down, you don't lose a penny. And then when it starts to recover and goes back up, you make money. Bottom line is this. Over every time frame we can measure, those of us who are honest and not trying to push stocks, bonds, and mutual funds because our company says that's the only thing we're allowed to sell and we get fired if we don't, which is true of most financial advisors out there. Over every time frame we can measure, some of the ups, none of the downs, ends up with a larger amount of money in your pocket with a lot more peace than any account that has all of the ups and all of the downs. Charlie Jewett with the Renovating Retirement Podcast. I hope that this was helpful for you. Don't let your money go down. You don't need to be in recovery. Don't lose 5 to 7 years waiting for the market to bounce back from a loss. Plan for those losses. It's called financial planning. Plan ahead of time for those losses. We know they're coming, and say, you know what? When the market goes down, I don't want to lose a penny. And the very day it starts to grow back up from that new bottom, I want to be making money, making money, making money. Charlie Jewett with the Renovating Retirement Podcast. I hope that this was helpful for you.